All right, FOMC, of course, today is the day. We've got a lot of roundups that we'll get into, which I think are going to be interesting with what is happening, not only from the macro aspect, but in general, how the markets are going to react to what the FOMC meeting result is. And of course, Chair Powell will go and be live streaming this today. So it's going to be a good one. My name is Paul Barron. Welcome back into Tech Path. A couple of things are going to happen here. And we've done these live streams before for you. And mainly what we do is we kind of go through just a little bit of overview of what's happened in the particular scenario up to where we are now. Obviously, the breaking news that just happened is that the Chair Powell, of course, did confirm the 25 basis points coming in. So that's the case right now. I think it's, this was what was baked into the market. So the real question is, how does the market respond from here forward? If you look at and we'll show you, there's some charts here. We'll be on and off Bitcoin and take a look at some sentiment today, do all that stuff. We'll also, of course, broadcast Chair Powell's announcement. And then, of course, remember that the big part of how the market reacts to everything that's going on right now is what his statements are after, and how he responds to the press corps, how he's being able to answer the inflation questions. Because the big questions today, and I think you'll hear this in the in the speech, is that we've already seen downturns 2 months in a row. Likelihood is CPI inflation data for February and March could be again also trending down based on the early data that's coming in from a variety of analysts and resources, is still showing some downtrend. Many of our own analysts have gone to the point of saying, hey, listen, this is one of those things that will most likely happen this year. We had Dr. Bear on. He was looking at it. We had Lynn Alden on, both of which we're looking at toward year end of possibly getting to some price stability. You'll hear that term a lot from Chair Powell's price stability. Mainly what he's talking about is inflation. But the theme I think that's going to be going throughout today's meeting and conversation is this: don't fight the Fed. It's going to be his message. And here's the theming that they're trying to get to here within it. Part of this will be the fact that Chair Powell is trying to hold the position. And you can kind of see here in the article says they're downshifting rate hikes, the cadence. This we knew actually early this year, last year. That we knew that we're only going to get 75 basis points throughout the entire year. So the likelihood is that as we start to see this 25, what would be the worst case? Maybe 2 more months of 25s, possibly. Or does he hold a couple of 25s in his bank to look at it through the year based on the data that he's coming in? Remember, this Friday we get the jobs report. That's the one that I think we need to be watching very closely. Further in this article, it says the bond market is suggesting monetary policy will be a lot easier than officials are indicating. And then we'll have a classic case of financial markets fighting the Fed. This is the thing, don't fight the Fed. And this is the scenario that I think a lot of people are going to start moving toward. And that is, they don't necessarily want to see that full-blown recession. It is a scenario that could be placed in here pretty significantly. There was another tweet here that I wanted to kind of show, just the price update and how this particular trader is going after it. Looking at the chart, a lot of his unfinished business remains in kind of the 22.3 level, which is about where we are right now. Let me jump over to the Bitcoin chart. Okay, so we're just clipping over 23. So we've been in and out of 23 most of this week and weekend after our little spike to almost 24 this weekend, which kudos to the CPI, we called that one. But what they go into, we could see a move towards that point area before we consolidate and then go to 23.3. This is kind of where it's floating. If the FOMC gets to 25, slight pump for a few minutes, then maybe we dump as he opens and gets into a conversation. And then, of course, we don't know. The 5.0 is not an issue right now. And then not necessarily. Now, we could, not necessarily in terms of no raise, but we could get into a scenario where Powell could indicate. You have to read between the lines of how he's responding to a lot of these questions that the press corps is going to be asking him. Inflation is going down. Why aren't you slowing? Why aren't you pivoting? If the jobs report comes in, what will be the response of the Fed? How much more data do you need before you can put the foot off the gas and we get into reversing interest rates? All of those questions are going to come at Chair Powell. So you've got to be paying attention to how he responds and the tone in which. He is actually not a great card player, because a lot of his poker faces start to come out in his comments. And that's something that I think with the way that he does these meetings is a good example. Now, with that being said, there's a lot of analysts that are still saying, hey, wait a minute, watch out. This was Michael Burry. This is the big short guy. Now, he put this out on a tweet, but he then immediately deleted it. I don't know if he's thinking, wait a minute, let me check that. We've got an option here, don't sell. Or is he just like, hey, I don't want to cause market panic and those kind of things. Burry is a significant Twitter account, and a lot of people listen to him, so I don't know. The other thing is, can Bitcoin really kind of hold its ground? Because remember, Bitcoin has flown over the last 2 weeks. We've seen significant increase in Bitcoin's number. Is this one of those scenarios where Bitcoin could fight through this, where traditional securities do not? And remember, we talk about this a lot on the channel, is that the possibility of Bitcoin coming out of this early is real. And we could get into a scenario where risk assets actually perform well as we start to make that curve into that point of a recovery, or in a scenario where we would see a pivot. A pivot is simply one thing. A pivot is not that he goes to no rate hike. A pivot is when he says, we're going to pull off a 10 basis point. That is a pivot in how the Fed will respond. I still don't think that's going to happen until probably mid-year, at which time we'll be looking for a lot of opportunities, kind of going forward. So some cool stuff. There was a couple of points here in this. Fed appears to be downshifting, quarter point increase. The crypto market is overly optimistic regarding the swift Fed pivot. I don't know that it's going to be swift. That's the thing. I don't think this happens in first quarter. Lund added that slowing momentum, strong technical resistance, and expectations of a hawkish point to a poor February. I'm still on the fence as to whether or not he's going to go hawkish on us. And what time is it? I'm just making sure we haven't missed him. So we got a few minutes before they get started. But I'm still at that point where I'm not sure if he is going to go hawkish. He's got a lot more data now that plays into this. And he may be in a position where he gives some slight indicators that, hey, he still has 50 in his bag. He may use it all at once, depending on what he sees in terms of inflation numbers. So we'll see how this plays out. The other thing is that, remember, guys, 38% of investors have lost more money than they've made. So this is not an easy win. This is still a bear market. Don't get your head in the clouds. I know that Bitcoin has run and we've got a nice position on it. Probably a lot of you trading in that. Many of you are trading some of these altcoins that have been running here recently as well. Good for you. But as I always say, take profits. Get your profits and move on, because right now the volatility of this is going to be significant as we get to kind of this next level. So something to think about. Another thing to think about is, when you look at what the future might hold, here's Bitcoin blockchains and wallets and smart contracts, of course, named by ARK as the 23 biggest ideas. Totally agree with them. This is what our channel is about. I mean, literally, that's TechPath and Metaverse Insider. But the future, I think, is really bright for what's happening right now. And I think a lot of the innovators that are investing in this and that are kind of taking a step into kind of where Web3 will go and all the associated technologies that play into this. People like Cathie Wood, she gets it. She knows what's up here. And remember, she called a lot of those early innovation stocks before they started getting pounded. Remember, that was when Cathie Wood rose to fame, was when her fund was over-indexing when everybody else was pulling back. So think about that. This was one of the statements she made in here. The price of Bitcoin could exceed 1 million in the next decade. This is coming from ARK, noting institutional interests, BlackRock, BNY Mellon, Eagle Brook, all those guys, Fidelity, we already know. The contagion issue is a scenario that we'll have to get through, and I think that is something that's going to most likely work its way out. But most likely, we've got to deal with two big hurdles in this next bull run. The first hurdle is getting the pain out of the market, because this is by far the most pain that this market has ever endured in its entirety. I mean, Mt. Gox was, I think, a pimple compared to the number of things that happened on. Maybe, again, that is coming because of mass adoption. When I say mass adoption, just a larger number of people in crypto right now that you guys know, you're watching our channel. But if we get over that and we don't end up with a lot more of the, kind of this douchebaggery that's out there in the market space, then we're probably going to be in a good spot for mass adoption of Main Street. And that one is going to be the key, because Main Street adoption will start to pull in institutional adoption. So all of that really kind of goes into. They talk about smart contracts, layer 2, Arbitrum, Optimums. You guys know, of course, Polygon. Also, they expect the number of digital wallet users to increase by 8%. I think this is going to go up a little bit more, mainly because of some of the solutions that are happening in digital wallets right now. A lot more innovation going on there in digital wallets. We're about 3 minutes out. We're going to be taking questions today. If you do like these kind of restreams, make sure and smash the like button right now. It does help, help people that are maybe getting into crypto for the first time. There's a lot of people that are doing that. Today is their first day in crypto. For those of you who are watching, and this is your first day in crypto, welcome in to what will be, I think, one of the most exciting times in your investing life, maybe in your education life too, because it is one of those spaces that you get a chance to be exposed to, something that's happening that not many people get a chance to really see. And that is the evolution of a next generation market shift. We saw it in the industrial age, the tech age to a certain extent. There's been many of them, from web, mobile, social, but I think Web3 is the next major one. I don't think it's like the number 4 spot in, the computer age. I think it is its own evolution because it has so many dynamics around what it's going to look like. Make sure and drop some questions in over on the side. We will try to get to those for you guys. Just as a reminder, before we get started here with Chair Powell, if you're not in our Substack, make sure and jump over there. This is where we've moved all of our Diamond Circle content. So you can just go pbn3.substack and you'll find us. The key here is we've got all of our premium content in there as well as our free content. So you can get to a lot of stuff there, including our CPI analysis. We're getting ready to launch the CPI newsletter. I'll just showcase that a little bit for you guys right here. This is actually going to be a way for you guys to get more, guided material around CPI, because that's one of the big things that we see a lot of people asking for is, hey, I like what's going on, but I don't understand it. So that's where we're going to do a lot more of that. So you guys will get a chance to see all that. Also, if you're not subscribed to us here on YouTube, all you have to do right there on the side, hit the subscribe button. It'll help you out. And it looks like they're getting ready to go live here in about a few minutes. So we'll keep it going. Love to get you guys your input. Do you feel that Chair Powell will become a little bit more hawkish here? Or do you think this is an opportunity for him to say, wait a minute, there might be a sliver of a window here in terms of going forward? Love to get you guys' feedback on that. The other thing too, when you look at Bitcoin, and let's take a look at the charts real quick. Looks like he's coming on right now. We'll go ahead and cut to that. Let me know if you're getting that feed over there. But yeah, it looks like Bitcoin is holding at around the 23,000 mark right now, still floating down, up a little bit from that red candle that we had earlier in the day. So Chair Powell has not made the podium yet. So we'll wait and see. Let me kind of move this out. We're on the... It looks like here he comes right now. Are you sending audio to me yet? Yep, I got it.
Good afternoon and welcome.
All right, well, here we go, guys.
My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5% to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, The committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris.
Chris Rugaber, Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil.
Hi, Chair Powell. Neil Irwin with Axios.
You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
Go to Colby and then Howard.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together. Although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything. So I think it would be premature. It would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation down. And how do we get that done?
In that sector.
There are many factors driving inflation in that sector.
Have inflation, the disinflationary process began.
Have inflation, the disinflationary process began in that sector. But so far we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard?
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros of the Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it, is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex-housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria?
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina, and then Steve.
Gina Smilik from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. And certainly be the as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and I mean, you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said the
All right,
extent
so we
that
get a lot
inputs
to
other
talk
than
about
wages
on
may be
this.
responsible
This is
in part for
some
important
very
price increases
interesting
for
statements.
some non-housing services,
We'll follow up
an
with some
unwinding of these factors.
questions.
In other words, it may
And
not
we
be
actually have
wages.
a
The
live
idea
with
that it
Evan,
may
so
not
we'll chart
require
some things out.
unemployment
The response
rising
to this,
to get this
kind of a
sector
follow-up.
of inflation under control. Thanks.
So a couple things. First, on the forecast, if you're right, if you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something around zero, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael.
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. and the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth.
This is a
my base case.
A big
is
FOMC meeting.
that
There
will
are
be
so
positive
many
growth this
things
year.
that Powell said today that really report. This is a very dovish position. Many things that he got into was this whole 5% as being a potential target zone for letting off, which means we would see a pivot. The other thing that I'm going to get into in our next live stream is this debt ceiling issue, because the debt ceiling is very basic, and I'll show you some stuff of what Biden, because there seems to be a clash going on, obviously, between the Republicans and the Democrats on raising that debt ceiling. If that does occur, it changes the outlook for the Fed in a very big way, meaning, you guys know this, fiat changes. And that, to me, is big news for risk assets. It's big news for Bitcoin. It's big news for Ethereum. And it could mean that we're going into that zone that is that early zone of adoption based on where the market is starting to get turmoil. Now, there's some big things here that we'll break into around the jobs report, which comes in on Friday. The deal with the jobs report is huge. If the jobs report comes in light, meaning a little bit lower than what it has done in the past few, either Powell knows something, or this is an extremely docile Chair Powell. Now, he knows he only has a couple more basis points changes, maybe another quarter and another quarter, that is really at his disposal before we start to see some adjustment here. He has already addressed that we are seeing response in the market. That's a big point. And he's expressed that 5% would be a potential target that they think they could get to the 2 should we hit it, meaning a pivot could still occur. Because remember, when jobs start declining, it's not something that just stops. It's like an avalanche. It will continue in its way, much like CPI, the inflation rates. It's an avalanche because these are usually trailing indicators that play into this. And I've been saying this a lot for months as we've come up to this point, is that jobs will be the key, as will be credit. That's consumer credit, which is going to be the big hammer that really starts to play into this. If you guys have been following it and follow the used car space, the car payment space, those are real world problems that people will start to feel. And when we see that occur in the market, this is when I think we see a lot of scenarios playing out. So, yeah, we're going to get a poll here, and there's still a lot of questions that they're asking, but most of it is kind of reiterating what they have gone through already. Why don't you stop raising? He explained that. We'll talk a little bit about that. Let's go to the poll real quick, and then we'll get to it. All right, so 24 hours after Fed, markets will have crashed drastically, skyrocketed, and remained unmoved. All right, so kind of split in the audience. Here's the thing that we're looking at right now. We have not dropped the sentiment for today. We're going to try to get that out this evening on Bitcoin and Ethereum, because we're pulling this in from the latest FOMC data. We'll take a look at amplification. because that will give us some indicators as to whether or not Bitcoin can hold this position. If you go over here and look at the chart right here, this was pre coming in. And again, this was this dip that we saw coming in on Bitcoin. If we go over here to the 4 hour, this was the dip that we saw coming in to the market as we started to look into FOMC. So the sentiment was definitely dead on where the market was flowing. Now the question is, how does it respond to what the FOMC meeting has resulted in? Unless Powell starts pushing anything on the backside of this that indicates any kind of wavering, I do not see that this is really going to be a big effect. If anything, it'll go unchanged, or we get some early moves here for maybe a run to 30K. All right, so I'm going to wrap it up here. We do have a live stream coming up right after this. We're going to do some altcoin analysis for you, and we'll talk about this again a little bit, but give you some more insights from that and dive into all that. You guys make sure and get in on Diamond Circle. It's really one of the best places. If you're listening to the podcast, get over here on the YouTube channel. You'll catch these live streams and a lot of other stuff that we do, charts like crazy. We get into interviews, all that good stuff. You guys want to catch me, it's out there on Twitter, @PaulBaron. We'll catch you next time in a few minutes right here on TechBath.